Did you know that a 100-point difference in credit score could cost thousands of dollars in extra interest on a loan? And here's the surprising part, many people damage their credit score without even realizing it. Visual, credit score meter jumping from red to green. Some of the most powerful credit score tricks are rarely explained clearly, even by banks. In the United States, a credit score affects almost every major financial decision. It can determine whether someone qualifies for a mortgage, gets approved for a credit card, or pays higher interest rates on loans. Credit scores are commonly calculated using the FICO Score, which analyzes different factors in a person's credit report. This video reveals credit score tips that banks rarely explain clearly. These strategies can help improve a credit profile faster, avoid common mistakes, and unlock better financial opportunities. Watch until the end, because some of the final tips can make a surprisingly big difference. Visual, credit score rising animation with dollar savings appearing. Section 1. Understand the 5 credit score factors. The first step to improving credit is understanding how scores are calculated. The FICO Score uses 5 main factors. Payment history, 35%. Credit utilization, 30%. Credit history length, 15%. New credit inquiries, 10%. Credit mix, 10%. Visual, animated pie chart showing credit score factors. Payment history and credit utilization make up 65% of the total score. That means small changes in these areas can have the biggest impact. Section 2, the 30% utilization rule. One of the most important credit rules is keeping credit utilization low. Credit utilization refers to how much credit is being used compared to the total credit limit. Example: if a credit card has a $10,000 limit and the balance is $3,000, utilization is 30%. Visual, credit card meter showing usage levels. Experts often recommend keeping utilization below 30%. But many financial professionals suggest going even lower, closer to 10%, for the best score improvements. Lower balances show lenders that credit is being used responsibly. Section 3. Pay before the statement date. Many people believe that paying a credit card bill before the due date is enough. But here's something banks rarely explain. Credit card companies usually report balances to credit bureaus on the statement closing date, not the due date. Visual, calendar highlighting statement date. That means if a high balance appears on the statement, it could temporarily lower the score. Paying part of the balance before the statement date can reduce reported utilization and improve the score. Section 4. Keep old credit cards open. Closing old credit cards may seem like a good financial decision, but it can sometimes lower a credit score. Why? Because credit history length plays an important role. Older accounts increase the average age of credit history. Visual, timeline showing older accounts boosting score. Closing an old card could shorten that history and increase utilization. Keeping older accounts open, even if used occasionally, can help maintain a stronger credit profile. Section 5. Limit hard credit inquiries. Every time someone applies for a loan or credit card, a hard inquiry may appear on their credit report. Too many inquiries in a short period can temporarily reduce the score. Credit reports in the United States are maintained by companies such as Experian, Equifax, TransUnion. Visual, credit report dashboard with inquiry alerts. Spacing out applications and applying only when necessary helps protect the score. Section 6. Increase total credit limit. Another strategy that can boost a credit score is increasing the total available credit. If credit limits increase while spending remains the same, utilization automatically decreases. Example: a $2,000 balance on a $5,000 limit equals 40% utilization. But if the limit increases to $10,000, utilization drops to 20%. Visual, credit limit increasing while usage percentage drops. Many credit card companies allow users to request limit increases through their mobile apps. Section 7. Check credit reports regularly. Errors on credit reports happen more often than many people realize. Incorrect balances, outdated accounts, or even identity theft can appear on reports. Consumers in the U.S. can check their credit reports from Experian, Equifax, and TransUnion. Visual, magnifying glass reviewing credit report. Reviewing reports regularly helps identify mistakes and dispute incorrect information. Fixing errors can sometimes increase a score quickly. Bonus tips. Here are a few extra credit score tips many people overlook. Tip 1. Use different types of credit. Having a mix of credit accounts can help a score. Examples include credit cards, auto loans, and mortgages. A healthy mix shows lenders the ability to manage different types of debt. Tip 2. Automate payments. Late payments can damage credit scores quickly. Setting automatic payments ensures bills are always paid on time. Visual, automatic payment notification on phone. Credit improvement takes time. Consistent habits such as paying on time, lowering balances, and managing accounts responsibly can gradually increase a score. Visual, credit score meter slowly rising into green zone. Over time, a stronger credit score can unlock better loans, lower interest rates, and greater financial opportunities. Section 8. Become an authorized user. Another powerful strategy that many banks rarely mention is becoming an authorized user on someone else's credit card. Where a person is added as an authorized user, the credit history of that card may appear on their credit report. Visual, credit card account being shared between two profiles. If the card has a long payment history, low credit utilization, no late payments, it can help improve the credit profile much faster. Many people use this strategy to build credit history early or recover from past credit mistakes. However, it only works if the primary account holder maintains responsible credit habits. Section 9. Small purchases can build credit. Some people believe credit cards should only be used for large purchases. But small, regular purchases can actually help build a healthy credit profile. For example, paying for a monthly streaming service, buying groceries, paying a phone bill. Visual, small everyday purchases being made with credit card. The key is using the card regularly and paying the balance in full. This builds a consistent payment history, which is the largest factor in most credit scores. Section 10. Avoid maxing out credit cards. Maxing out a credit card can significantly lower a credit score. Even if the balance is paid off later, high utilization may already be reported. Example: a card with a $5,000 limit that reaches a $5,000 balance shows 100% utilization. Visual, credit meter turning red at 100% usage. High utilization signals financial risk to lenders. Keeping balances low helps maintain a stronger and more stable credit profile. Final thoughts. Credit scores may seem complicated at first, but the basic principles are simple. Pay bills on time. Keep credit utilization low. Maintain older accounts. Limit unnecessary applications. Monitor credit reports regularly. Visual, checklist of good credit habits. Over time, these habits can gradually improve a credit score and open the door to better financial opportunities. Higher credit scores can lead to lower interest rates, easier loan approvals, better credit card rewards, more financial flexibility. In many ways, a strong credit score becomes a powerful financial tool. And once the right habits are in place, that number can begin working in your favor, unlocking opportunities that were once out of reach. If these credit score strategies were helpful, make sure to like the video, thumbs up, and subscribe to the channel for more content about personal finance, smart money habits, and building long-term wealth. Money bag chart increasing. Also turn on the notification bell so future videos about credit, investing, and money-making strategies never get missed. Small financial habits today can lead to big financial advantages tomorrow. Bonus tips. Here are a few extra credit score tips that many people overlook. Tip 1. Set up automatic payments. One late payment can stay on a credit report for years and significantly damage a credit score. Setting up automatic payments helps ensure every bill is paid on time. Visual, phone notification showing automatic payment confirmation. Payment history is one of the most important factors in the FICO score, so consistency matters. Tip 2. Use credit regularly but carefully. Using a credit card occasionally keeps accounts active and shows lenders responsible credit behavior. Small purchases paid off quickly can help maintain a healthy credit profile. Visual, credit card being used for a small purchase, then balance dropping to zero. Tip 3. Monitor your credit progress. Checking a credit report regularly helps track improvements and catch potential problems early. Major credit reporting companies in the United States include Experian, Equifax, TransUnion. Visual, dashboard showing credit score gradually increasing. Final message. Improving a credit score doesn't happen overnight. But with the right habits, patience, and consistent financial discipline, credit scores can steadily rise over time. A strong credit score can unlock lower interest rates, better loan approvals, and greater financial freedom. And once those financial doors begin to open, the benefits can last for years.